Lacaille, Global Chief Investment Officer at State Street Global Advisors. He helps oversee around £1 trillion of assets. Rick, let's start stateside. You've got an overweight position on US equities. The macro numbers have been trending off a little bit of late. We've got a number out today. I think we're looking for about 160 on a Bloomberg estimate. How comfortable are you with that overweight position?
We're very comfortable with it. It's not predicated on today's jobs number, I should add.
Of course.
But I think the long-term trend continues to be pretty good in the US. Obviously, you've got the fiscal wall that might be facing us next year.
Yep.
But if you look at securities markets, companies are doing well. The earnings are not expensive at about 14 times. And we feel comfortable, certainly against other asset classes in the US.
You've got a kind of top-down view on Europe. You could argue that Europe looks cheap. You can, from a stock picker's point of view, find some great companies around Europe that are being tarred with the sort of, say, the Spanish or the Italian brush. But you're still happy that you should overweight Europe, despite overweight the US, despite the valuation story potentially in Europe. Yeah,
I think there's a cheapness about Europe, but there's a lot of risk. There's a referendum risk, and from a top-down investor's perspective, it's a reason to be a little bit cautious. If you're thinking about from a fundamental stock picker's perspective, I'm sure there's been some enormous overreactions in Europe.
Yep.
If you look at the diversion between Spanish companies and German companies, and if you're looking at the underlying fundamentals, the return on capital and how sustainable that is, what sort of a quality business you can find in Europe, I think you'll find that there are opportunities. But again, from a top-down perspective, from an asset allocated perspective, I think we're cautious.
Is there a sort of, do you need to get the politics out of the way in Europe? I know that's going to be very hard for a long time. We've got plenty of elections this year, and we've got German elections next year. Like, is that something that's just going to sit on top of the European story and create a problem for owning assets here for quite a long time?
Well, I think companies will have to fight that story. I think the politics is going to be around for a while because many investors are assuming Hollande won't do what he says he's going to do and it won't be as bad as people think.
Yeah.
I think that's a gamble, frankly, and I think they have to understand that there is a risk that the French population really do want significant change, and that might affect them. But at the same time, individual companies will be fighting that story in terms of what they can do from a bottom-up perspective. And I think many French companies can, really deliver the goods.
So be nervous of the politics, but you've got to look quite carefully.
You've got to look at the stock level.
Yeah, precisely. Margins are high at the moment. Are they going to come off? What does the productivity story look like? And is this something that I need to be increasingly aware of as I look at the valuation arguments?
I think you do. There's a kind of good story and a bad story there. Hours worked has gone up. Payroll numbers probably going to be pretty good, but productivity growth is flagging. Now, why is it flagging? There's been underinvestment. So you could say the next stage of the recovery in the US may be a surge in fixed investment. Now, it's hard to see why that's going to happen because there's a lot of caution in boardrooms. Yep. But ultimately, that would lead to a more sustainable recovery. But at the moment, you've got Labour picking up a little bit more in terms of their share of the GDP pie, and that may be good in terms of making that recovery a little bit more sustainable, and particularly affecting the housing market.
It's coming off a very low base, though.
Coming off a very low base. And it's not affecting everybody, so it's a very patchy recovery. And that's why, although you've got quite high unemployment, you've got this flagging productivity growth in some sectors.
Fixed income has delivered for me. It's turned around a nice month in April. For instance, you look at US Treasuries, the yield's falling. You look at Germany, and the yield is certainly falling. Why should I be thinking that's now time, I should be now looking to exit that position? Because, I don't know, compare Germany with Japan, you could say there's massive gains still to be made here. Yeah, I think it depends what your preferred habitat is. A lot of people have put money into fixed income mutual funds. You've seen a lot of money going into ETFs because the yield story and the term premium is enough for people. But if you're looking at it from a long-term investor's perspective that needs to beat their liabilities or needs to beat inflation by 4 or 5%, fixed income markets are not going to do that for you. And you have to be a little bit concerned about where yields are in the safe havens like Germany, particularly when you think about the German employment picture. It's got the lowest unemployment for 20 years. Companies are still knocking out the lights. Now, we've got some weakness in PMI data, but I think that is a little bit of a cautionary tale for bond investors. But it's a return of your money rather than a return on your money when it comes to that argument here in Europe.
But it maybe we look, and again, we look backwards now at why we ever bought Greek bonds. Maybe in 5 or 10 years, we'll look back on this period and say, why on earth did we lend money at almost zero real rates for 10 or 20 years?
Yeah, interest rates are effectively negative. Why am I not owning corporate credit? Why am I owning equities rather than corporate credit?
Well, corporate credit is interesting, but I think it's a little bit less attractive from a pricing perspective. And certainly in Europe, credit spreads have been squeezed, so there may be a better entry point for credit in Europe in coming months.
Emerging market credit over developed world credit?
Don't have a view on that.
Right. Because a lot of people, the search for yield is out there,
Yeah.
and you're trying to figure out exactly how on earth you make some money and generate a decent return, and you're kind of scratching around.
Frankly, at the corporate level, emerging market credit can be a little bit inaccessible. I mean, certainly if you look at Asia, there is a corporate credit market, but issue sizes tend to be small. It's not a very liquid market. It's not as mature, not on the corporate side, rather than the govy side. No, the government side is a completely different story, where I think if you look through to the fundamentals, there's still an attractive story there, but it's largely a currency story. So you've got to be cautious and watch out for the point where currencies begin to become fairly valued or overvalued.
Post-November in the US, is there... election years in the US, if I look at the Almanac, tend to be fairly good years. Post-November, what does the story look like?
Well, post-November, you'll be facing the 2013 fiscal wall, as people call it, and that would knock a significant amount off GDP if nothing was done. History would tell us that the US administration will muddle through, and we won't face that fiscal wall and won't have the drop-off. But it's clearly a risk for investors.
When do I start pricing that in? I'm looking for an exit point in the outperformance of the US. I'm thinking, do I need to think about 2013? There may be a strong reason to lighten up. As you say, muddle through is probably the best option. But is that something I need to start discounting, and when do I start discounting it?
Well, you may not be too long to wait, because the candidates need to get on top of that issue in terms of their re-election agenda in November. So I think you're going to hear more about how they're going to deal with 2013 as you approach November.
Would you say we're at the year highs on the US markets? We're approaching those?
Well, if we thought year highs, we wouldn't be long of US equities.
No.
So we do certainly think there's still some more to go.
How much more?
We're in low double digits.
Yeah.
We're in single digits, not double digits. But certainly, if you look at the earnings growth that we're still seeing coming through, despite everything we said about margins and the reasonable valuations and the really bad alternatives, which are very low yielding assets, then I think investors may well be enticed the rest of the year.
Rick, nice to see you. Thanks for joining us. Rick Lacaille joining us from State Street Global Advisors.